name is Wes Patton, and I'm a partner and senior wealth advisor here at Mission Wealth. Today, I will outline some behavioral biases that affect investors deciding to sell investments. While selling decisions may seem purely financial, behavioral biases can often play a major role in how investors respond to gains and losses. One of the most common biases is called the disposition effect. This occurs when investors sell winning investments too quickly while holding on to losing investments for too long. Psychologically, realizing this loss feels painful, so people will often delay selling in hopes that the investments will recover. Research shows that this behavior can significantly reduce an investor's returns. As an advisor, I help clients address this by creating a structured plan for selling certain holdings. For example, we can utilize limit orders or hedging strategies to ensure that certain holdings will sell only when a specific set of circumstances align, rather than simply based off of a feeling or emotion. Another related bias is regret aversion. Investors will often worry that if they sell an investment and then it later rebounds, they'll regret the decision in the first place. Because of this, many fear that they may delay selling or avoid making an allocation change altogether. To help manage this, I focus on long-term planning and scenario analysis. By modeling potential outcomes in financial planning tools, clients of mine can see how disciplined decisions support their broader goals rather than simply focusing on short-term market movements. A third bias is the status quo bias, which is the natural tendency to prefer inaction over action. Investors may hold onto the same positions simply because change feels uncomfortable. Over time, this can cause portfolios to drift away from their target allocation. One way to address this is through automated rebalancing and scheduled portfolio reviews to create a consistent process for making sure that adjustments are happening rather than relying on emotional decisions. Finally, there is myopic loss aversion, which occurs when investors focus too much on short-term market fluctuations. When people check on their portfolios or the market frequently, short-term volatility can feel more significant than it really is, often leading to premature selling of investments at a bad time. To help counter this, I emphasize long-term investment horizons and focus on client reporting broader performance rather than just daily market movements. Ultimately, successful investing is about more than just choosing the right investments. It's about having a disciplined process that helps manage emotional decision-making. By combining behavioral insights with structured planning and technology, advisors can help their investors and clients make more thoughtful decisions about when to sell certain holdings and when to keep certain holdings that are better aligned with their long-term goals. Of course, if you have any questions about any of the concepts outlined today, feel free to ask your wealth advisor here at Mission Wealth. Thank you.